of red across the global markets. Do you see some more carnage across the screen, or do you think this will be the pause of the global rout?
Well, I think that the next few days are going to be quite critical. The earnings coming out of the U.S. haven't been too bad, and in general, the economic news hasn't been too bad, but there have been rather two very slightly gloomy issues. One is that U.S. housing doesn't look quite as strong as it has been, and the other is it does look as if some of the concerns about tariffs are starting to bite. So perhaps what the Chinese were saying about tariffs would hurt America as well is true, although obviously they've hurt China even more. So markets are concerned. Markets are volatile. We said they'd be volatile in February, so we shouldn't be too surprised. And to have a flat reading on the year, which we have at the moment in the U.S., isn't too bad. So I think the next few days will be critical. What we want is that the selling doesn't create more selling, but that this is just, if you like, a cooling down of what's been a really pretty positive market for the last 2 years.
You know, a lot of people on the street, Richard, at this point of time are talking about a very murky picture for earnings visibility for several companies next year, which has also added on to the jitteriness of investors. How bad is the picture looking like at this point of time, and what are these companies or sectors which could be the worst performers from here on?
Well, I think bad is probably the wrong word. I think what investors are concerned about is we have had a series of pieces of bad news. You know, the geopolitical news, for instance. Economies have slowed down a little bit in Europe. Emerging markets have obviously been hit by the strong dollar. You know, so the news hasn't been as good as it has been. But also equity markets have been really quite buoyant, you know, even though we've seen quite big falls this year. If you look at it on a 2-year view, it's not quite so bad. And if you look at it on a 3-year view, the markets have done quite well after a pullback around 2016. But I think what we need to remember is that markets have good periods and then they have rather dull periods. And occasionally they have a little crash. At the moment, I think we're in a year, which is a year of consolidation, where markets are likely to basically tread water. And of course, the markets have to find excuses to do that. And I think at the moment, they're looking for excuses. Basically, you know, the earnings are good, but they're not good enough. There are a few little black clouds here and there. I don't see this as being serious unless the markets feed on themselves and fall off substantially. I don't think that's likely to happen. But I do think that this is a year of consolidation.
Right. Richard, you're sounding quite optimistic. Just, wanted to understand, you said there are a lot of positive triggers as well, but right now what we are facing is mostly negative triggers, negative macros, an increasing, a rather strengthening dollar, weak outlook for earnings, global trade concerns. Nothing seems to be going right at this point of time. For how long do you see the pressure continue?
Well, I think it's easy to convince ourselves that this is all really bad news. You know, many of these pieces of news come up from time to time. Don't forget, last year we were worried about nuclear war in the Koreas. These issues do come up from time to time. I wouldn't say I'm massively optimistic. What I am saying is that the chances are that this is quite a big pullback, 600 points on the Dow. Used to be really quite serious, but of course the Dow is much higher now. That the biggest concern is these pullbacks feed on the markets and create other pullbacks, that more people decide to sell, and this then starts leading to some real damage in the markets, to maybe some debt defaults, this sort of thing. At the moment, I don't think we're going to see that kind of contagion. And after all, in the U.S., we're only at a flat year. We're not even seeing a down year. And the previous 2 years have been really rather good. If you could look at pretty well a straight line up from March 16 through to the beginning of this year, the markets rose really quite surely and quite substantially. So to have a pullback isn't too bad. So I'm optimistic that we're not going to have a crash. But obviously, I'm cautious in saying that this year is going to be pretty flat.
And talk about the Asian markets, the emerging markets across the world. How far away are we from the bottom as far as the EMs and specifically Asian markets are concerned? What can we expect given the kind of global cues?
Well, I'd like to know the answer to that myself. What I think in China, though, is that this move the other day by the Chinese to seek to buy the market was probably pretty important. You know, they so far you might say it's failed, but the market is finding a pretty solid level at around the 2540 level on the Shanghai index. And if that's where the authorities wanted to stay, they're probably going to bring in more and more tools in order to try and keep it there, either by having state-owned agencies buying the market, or by giving tax relief back to individuals, or by increasing liquidity. You know, they do have, or by reducing interest rates. They do have a number of tools at their disposal. And I think actually that's quite important, because if the Chinese market steadies, that may give a little bit of succor to various other emerging markets to also steady. And don't forget that the U.S. market has been playing to its own tune anyway over the last year or so. So I think that intervention in the market is quite important. So whether we're at the bottom or not, I don't know, but I think that was an important intervention that maybe indicates that that's where, certainly in China, the government feels enough is enough.